afternoon, everybody. Thank you very much for having me today. I'm going to speak a little bit about JPMorgan Global Growth and Income. I'm going to talk about how we think about running the portfolio, where we generate our insights. So this is just the overview slide, really, and I think there's three key points I want to leave you with here. Firstly, well, what do we deliver to our shareholders? We deliver a concentrated best ideas portfolio, picking from stocks all around the world. So we have a wonderful analyst team that we utilize to do this. They have on average 19 years experience in the industry. And this is an investment discipline that we've had in place at JPMorgan for more than 3 decades now. And I'll talk a little bit about how those analysts think about forecasting, how they think about identifying those very best ideas, and ultimately how we build the portfolio around that. The final point, which really is important, and after all we are talking about income today, is that you get the best of both worlds with JPMorgan Global Growth and Income. We offer you a 4% yield based on the NAV at the end of the financial year, which is the end of June for us. But we pay part of that out of capital reserves. And the benefit that brings is it means we're not looking to the underlying portfolio companies to have to provide that yield. About half of the yield does come from those companies. But it means for companies where we see the opportunity much more as capital appreciation rather than income, plenty of companies in the US, of course, don't pay dividends. It means we can capture those opportunities, we can deliver to you that capital return, as well as that predictable yield every year. Just on the next slide, I've got a quick overview of a snapshot of the fund. So you've got some very unflattering pictures of the portfolio management team, of whom I'm one of 3. So I am based in New York. As you can tell from listening to me, I'm not originally from the US, but I've been here now for getting on for 8 years. And Helgi Skabelli and Raj Tanna, my co-PMs, are based in London. And we think that geographical spread is actually very beneficial when running a global portfolio. On the upper right-hand side, you have a couple of stats just of the fund as of the end of October. Really what this is telling you is that the fund currently has exposure to companies that are growing on average faster than the benchmark, but also a little bit cheaper. So we're looking for that combination of good growth, but also attractive valuations, and that's very key. And of course, on the bottom right, you have performance over multiple time periods, which I'll touch on in a bit. So if we move forward 2 slides, this may not seem like the most important slide to you, but I promise you, to me, I think about this as probably the most important slide I'm going to show you. And it's because of the strength of the analyst team that I get to work with every day. It's the experience, it's the intelligence of these individuals, and really the work that they do is what gives us the ability to run this fund today. We have more than 80 analysts all around the world. We believe in that local approach. We want analysts to be based close to the companies that they're covering. We want them to be able to go to the factories. We want them to meet with management. We want them to do all of those things. And whilst the world might be a bit more virtual now than it used to be, there really is no substitute in many instances for feet on the ground and going to visit companies. Now, these analysts between them cover 2,500 companies. They meet those companies regularly. We have regular engagement with senior management, but also people further down the pole as well. And we put significant resources behind this team. So we spend $150 million a year on our research budget. That's everything from sending the analysts to those factories to buying credit card data sets to really help us understand some of the trends that we're seeing in the world today. And on the next slide, this is really simply to make the point that we're focusing on the long term. We're not asking the analysts to look at that blue line, the volatile cyclical line, and try and predict those short-term changes. That's very, very difficult, and we don't think that's where we can add value. What we are asking them to think about is the long term, is the structural change. What industries in 3, 5, 10, 20 years do we think are going to be generating great returns? Which companies within those industries do we think are going to be the winners? These are all questions we ask ourselves. And we think by adding the most value to you as shareholders is by focusing on that purple line. Now, on the next slide, this is a tool which, again, it may not look like the most important slide to you, but in terms of what I do every day, this is absolutely critical. So when we're thinking about those 2,500 companies that we cover around the world, we need a consistent framework to really analyze and understand a business and be able to compare those businesses. Because as I said, we're looking for the very best ideas to invest here. We're not looking to buy 1,000 companies in the portfolio. We're looking to buy between 50 and 90. At the moment, we own just under 60 stocks. So how do we do that? Well, this is the framework, what we call strategic classifications, a tool to understand the business. Every one of those 2,500 companies will either be premium, quality, trading, or structurally challenged. Premium is reserved for the very best companies around the world. Quality for very good companies, but perhaps not quite the same economics, or maybe we're worried about the growth a few years out. And at the other end, structurally challenged, as you might imagine, are companies where we have real concerns over the next few years about their ability to even be viable businesses. You might think about a tobacco company and the risk of regulation simply destroying their business overnight. So within all of this, we have to really understand each company. And we've divided it into three buckets here. The first is economics. In very simple terms, this is, does a company generate good, sustainable returns on capital? Do they generate good cash flow? How are they funding that? What does the balance sheet look like? But the middle box is perhaps much more important, because it's one thing to get a snapshot of a company's economics today. It's quite another to predict whether or not they can see duration in their business. And to us, that means, can they sustain those returns? And a great number of things go into this box. Some of them will be environmental and social factors. If we're thinking about oil companies, we of course have to think about the environmental impact of oil. We have to think about the power generation mix in the coming years changing. We have to think about the industry structure and the growth of an industry. We want to look at whether or not there are lots of different players, all of whom are doing pretty much the same thing, or whether it's a more concentrated industry where certain companies are really adding a lot of value themselves. And then of course, moats, competitive advantages, R&D spend, innovation, these are all things that we have to think about when we're thinking about whether a business is going to be around in 10, 15, 20 years. And finally, governance. Well, governance is critical. In some ways, this can be summed up very much as, do we trust the management to sensibly spend the cash that that business generates? Because it's all very well having great economics, having economics that we think can be sustained for a long period of time. But if we think that management is going to waste all of that cash, well, that's not going to be a great stock. So we have to really understand the management. That's why we put so much focus on meeting with companies. And we have to understand how they're going to allocate their capital. Now, on the next slide, the only point of this really is to emphasize that the valuation does matter. We're not looking to buy growth at any crazy multiple. We're looking to be disciplined. We're looking to generate good performance for our shareholders by thinking firstly about the strategic classifications and finding those premium and quality businesses, which is really where we focus, but then identifying which of those premium and quality businesses are actually the most attractive. Where do we think we can generate the best returns? And so having a consistent framework, again, for each of those 2,500 companies is absolutely critical. On the next slide, I just want to briefly mention ESG, which is, of course, very, very important and getting more important. We completely integrate our ESG analysis into our fundamental research. Those same analysts who are covering the companies all around the world are the ones that analyze them from an ESG perspective too. And we think what that does is allow us to firstly benefit from their expertise. These people are experts in the companies that they're covering after all. But then it allows us to really understand what the impact of the ESG threats or opportunities are going to be on a business. It could be that a supply chain for a retailer we think is concentrating in countries where they're not treating workers particularly well, where they're not paying a fair wage. And actually, you need to understand the implications of that for a company's margins. So it's really integrating all of this, which we think is a very powerful tool. I'm going to skip the next slide, which really just talks about some of the engagement we do. And slide 10 after that really is summarizing what I just said about the process. But why don't we move on a couple of slides and just very quickly talk about performance. Now, a lot of this is going to be somewhat self-explanatory. The only point I will make here on slide 12 is that the trust has been trading at a premium for the past few years, ever since the board changed the dividend policy, which I mentioned earlier back in 2016. And we're pleased to see that it continues to trade at a premium today. The next slide talks about the returns over different time periods. We've had a strong year. We're pleased with the year, but of course, in this industry, you never end a quarter or end a year and say that that's it, job done. This is always about continuing to generate that performance for our shareholders, because people do rely on this for income, and ultimately we believe that we can add value to their investments. And the next slide really just talks about, over the past year, some of the stocks and sectors which have contributed to that good performance. Now, of course, we're looking to get everything right, but it's impossible to get everything right. So on the right-hand side, we also show some of the biggest detractors. On the left-hand side, some of the stocks that have worked. Alphabet, which is the parent company of Google, has been a very strong contributor and a name that we continue to own today, although we have cut back on the position size given the strong performance. A name like Lyft too, which we've actually been adding back to. So this is the #2 rideshare operator in the US after Uber. And of course, they've had a very challenging couple of years with coronavirus, and ultimately that hit their business significantly. But we have a very high conviction view on Lyft that says that in 10 years' time, people completely underappreciate how strong a business this is going to be. Now let's talk about positioning, because I don't want to go past my time. So on slide 16, this just gives you a bit of a snapshot of our positioning from a sector perspective. So which sectors relative to the benchmark are we overweight and which are we underweight? And on the right-hand side, I think that the granular detail is helpful. And firstly, I'm going to point you to the bottom, to the area that we're underweight, which is technology. And software is actually the sector we're the most underweight. When I look around the market today, and this is particularly true in the US, valuations in some software names are completely out of control. We think there are some egregious overvaluations of certain companies out there. And when we look at the history of really every company or industry, but particularly in software, not all companies are going to be around in a decade's time. But every single one of those companies that I think about when I look at the valuations is being priced as if they're not only going to be around in 10 years' time, but they're going to be incredible businesses which have tens of billions of dollars each in revenue. And we can look at all of economic history and know that that quite simply isn't going to be the case. So we're looking to identify with our analysts the companies that are going to be around, but we're looking to avoid areas where the market's got very, very ahead of themselves and where valuations just don't make sense. And software, for us, is the poster child for that right now. Now, I do want to talk about semis and hardware, which is just above that, because this paints a slightly confusing picture. Within semis and hardware, you have semiconductor companies like NXP Semiconductors, which is one of our top 3 holdings, where we feel very optimistic about the next 3, 5, 10 years. And so we're overweight semis as a sector. But within that, you have hardware, which is why we're underweight. Hardware is companies like Cisco, which whilst JPMorgan, when I look around this office, has been buying more Cisco equipment over the past year because we're all now doing all of these things virtually a lot more. We think that that business long term is still going to have a huge number of challenges. And so we don't own really anything within the hardware space, but we do own stocks within the semiconductor space. So that was an important nuance just to draw out. Up at the top, you can see a couple of sectors: retail, banks, and consumer cyclicals, which tell you a little bit about how we feel about the world right now. We feel quite positive about the consumer, about economies around the world. We're coming out of COVID, we think, in a good position. And we look at the consumer, especially in the US as an example, where the sheer amount of stimulus, the sheer amount of money, be it unemployment, help for those that lost their jobs, it was sizable. And consumer balance sheets are in a better position than they have been for a very, very long time. And so when we look at retail companies like Adidas, which we think are primed to benefit from that, we see a really good opportunity. Now, the next slide just talks about our current top 10 active positions. Amazon is one where, if I think about the way the world has evolved over the past 18 months, it was a very large position for us 18 months ago as we went into the pandemic. And the stock did very, very well over those next 6 months. And as I mentioned, we're disciplined on valuation. So we cut back on the position. Amazon at this point really hasn't done much as a stock for getting on for a year. Some of that's understandable, of course. It's been a very strong 12 months, and it's hard to grow much more when you had so much buying, so much e-commerce last year. But longer term, this business remains phenomenal. We think we'll see a real re-acceleration in the e-commerce business. The AWS public cloud business, I think, is a bit of an underappreciated jewel. What the public cloud means is for companies like JPMorgan, if we don't want to be running huge server farms in various different places around the world, we can outsource that. And you can outsource it to Amazon with AWS, to Microsoft with Azure, and to Google with Google Cloud as well. And we think all of those businesses will benefit from, of course, the growth in data. A couple of semiconductor companies in there too, in the top three, Analog Devices and NXP Semiconductors. As I mentioned, we feel very good about some of these semiconductor companies. If you think about electric vehicles, just as one good example, the number of semiconductors that are in a car today versus 5 years ago has gone up exponentially. We think that will continue. In an electric vehicle, actually that semiconductor content really does go up very significantly, even more. And so there's a long pathway for growth that we see for these companies. Names like Wells Fargo, perhaps slightly more controversial, but it's a bank in the US that's had significant problems over the past few years. And actually, we think they're coming out of those problems now. It's under the surface. It's a really fantastic bank. They have a top 3 deposit base in all of the 32 states that they operate in. But that's been lost with mis-selling scandals and management changes. But we think now they're in a very good position to really continue to grow again. So if we just move to the next slide, this talks about some of the structural changes that we're seeing. And if you think what I said about the purple line on that slide a few slides ago, this is what we ask our analysts to focus on. We ask them to think about the public cloud, which I mentioned. We ask them to think about healthcare innovation. One company that really stands out is Novo Nordisk, who make the best-selling drug in the world to treat diabetes. Well, diabetes is certainly a disease which is becoming more of a problem. And they recently announced the approval of a drug to help with weight loss. And if I look at the market in the US for weight loss drugs, it's certainly a significant opportunity for them. The new energy revolution, well, NextEra Energy is the largest power generation renewables player in the US, and we think there's a very long runway of growth there too as we move away from oil. So just these good examples of themes that we ask the analysts to really dig into and properly understand. Now I can see on my timer that I have 1 minute to go, so there are a couple of stock examples which I won't touch on, but really I'll move just to slide 21, and I'll summarize what I said at the start, which is we're delivering for our shareholders an unconstrained best ideas global portfolio. We're utilizing a fantastic research team to do so, and we put significant resources behind that team. And we're delivering the best of both worlds. So not only are we focusing on generating the best capital appreciation for our shareholders, but we offer the predictable 4% yield every year. So with that, Roland, I'll hand back to you. Thank you very much.